What drives stock market returns? Let's clear up some misconceptions about where returns come from, the role of dividends, when they're good, when they're not so good, and how to think about them. So let's think about it using a common savings tool. It's instructive because it eliminates some of the noise that comes with looking at a strict company which has a lot of other things going on. So we take a common savings account and we're going to give it a little twist. We'll call it Savers Inc. And so this is, instead of this account being just you or just you and someone else, it's going to be you and 9 friends. So we have one account with 10 people contributing $10,000 each, or $100,000 in total. Now this is a special savings account. It has a 10% interest rate. You have a 20% tax rate. Any money that you reinvest into this account also pays 10%. And any money that you distribute incurs an additional 15% tax. Now, what we've just described is a corporation with double taxation of dividends. But let's just keep this savings account in mind because it really is no different than a company. So you and your 10 friends, you take your $100,000 and it goes into the bank. Each of these 10 friends owns 10% of the account. Now, what happens at the end of year one? We have our deposit, which represents the equity in the account of $100,000. The pre-tax return, which was 10%, results in interest or earnings of $10,000. And our 20% tax rate requires a tax payment of $2,000, which results in net income of $8,000 for the account. So you and your friends each have a 10% interest in the account. And so your earnings are $800. Your friends gather around a table and decide what to do next. You have 3 options. You can reinvest the $8,000 in total, each of you reinvesting your proportional $800 at 10%. You could distribute all of these earnings, or you could do some combination of the two. So under scenario 1, reinvesting, we have the original $100,000 capital, the $8,000 earnings. And so these are going to compound at 10% and result in year 2 earnings of $10,800. We'll pay a tax on that and will result in additional capital growth because of the reinvestment of $8,640. So your share has grown to $864. Now, what we've just seen here is the pie expanding. Each friend owns the same 10% of this savings account or this company, if you have that in mind. It's just a larger pie. So you have the same percentage ownership of a larger earnings power of this business. Now, of course, we could also distribute all of these earnings. So the $100,000 earns $8,000 just as before, except now when dividends are distributed, we need to pay an additional 15% to get that cash into the hands of owners. So that is going to cost $1,200 and result in $6,800 left over. So each of the individuals that own their 10% of this account are going to have a proportional cash flow of $680 after tax. Now, this illustrates a key point in dividend investing or just dividends in general, in that in a taxable scenario, in the outside of any tax advantaged account or retirement account, distributing cash from the corporation is going to incur an additional tax. So shareholders will now need to take that cash, that capital, and do something with it. And so if you owned this savings account or part of it, you would want to know that what you were distributing, the opportunities that you had outside of Savers Inc. were better than what was in it, because reinvesting the capital, as we will see very soon here, actually results in a lower rate of increase because you're paying this additional tax, which would not have been necessary to do if you were just simply retaining the earnings in the company. And so it's important to recognize here that each share is still worth $10,000, right? Because we have not increased the earnings power of this business. We're assuming that it can only earn 10%. In the real world, most companies require reinvestment to grow in some form, whether it be in working capital, physical plant, or other types of investments. Most companies, they can grow if there's margin growth or some other temporary things, but those cannot go on forever. At some point, additional capital needs to be put into this business. And so there's a couple of things that can happen here. So if you wanted to buy an additional ownership interest in this business, you could ask your friend if they would like to trade some of their ownership for your cash dividends. And so under this scenario, the company is going to distribute all of its earnings, pay the additional tax, which would happen on an individual level. And so you would swap your $680, which are the after-tax cash distribution from your proportional earnings, for a percentage of a friend's interest in the business. You give up the $680, they give you 0.68% of their ownership interest. And so you're using your earnings to buy out some of your friends. So the ownership of the business remains the same in total. You still have the 100%. 8 other people have a 10% interest. You now have a 10.68% interest, and this other friend has a 9.32% interest. And so everything about the company stays the same. It's just the ownership that changes. You will earn more under this scenario, but it's less than if the company retained it because you were paying that extra tax. And so this is no different than a dividend reinvestment plan in which some brokerages and directly through the company have set up for shareholders. And what we see here is essentially this dollar that was earned. We have this 10% earnings getting squeezed down by the tax rate at the corporate level, and then again at the individual level. And then for that to go back in, it's very inefficient. So we can see the reason why some companies do not pay dividends, and it's much more tangible. It feels like you have a greater ownership interest by receiving that cash and then buying more shares. But in reality, owning a larger share of that same pie, a larger pie, is in fact the better route to go to build wealth. And so the key is opportunity cost. If the money can be put to better use inside the company, it should be retained. And if the shareholder has opportunities elsewhere and the company cannot earn a satisfactory return, it should distribute some of that capital to shareholders. And hopefully this illustrates that the ultimate source of returns comes from the company itself. And so retaining earnings and reinvesting into the business grows the pie. If the company distributes money and the shareholder takes that and either buys shares from other individuals, whether it's a private company or in the market, it's the same thing as taking that capital and buying a larger slice of the pie versus a growing pie. And so dividends are just a component of the returns. It's not magic. The all retained earnings policy tends to create over time higher capital gains if the company is successful at earning a good return. An all dividends policy will have the effect of causing the returns to be greater in the dividend portion, which could be reinvested in that company or could be put into another investment. But all things being equal, an all dividends policy is going to keep that pie the same. And so remember the reinvestment plan under scenario 1, in which the company takes all of those after-tax earnings at the company level and reinvests into the company for year 2. Each friend is owning the same percentage, just of a larger earnings power. And so how could you get cash after year 1 without the company paying dividends? And we see this in companies that do not pay a dividend. Berkshire Hathaway is one good example, which has for many years, decades in fact, not paid a dividend, but it has reinvested that capital, and its potential future dividends go up as that reinvestment occurs. And over time, in the market, over time, if it's rational, which over time it is, but in this example, let's just assume that it's purely rational in this savings account example, that retention of earnings is going to cause the value of the account to go up, which translated into other terms is really a capital gain. And so instead of taking dividends and having someone else buy that proportional share of your earnings, we are going to sell some of that ownership without taking that cash, because remember, the company is not distributing it. And so under this example, the company would have earned $8,000. Your 10% would have resulted in a $800 capital gain, all things being equal in this simplified example. And so at the end of year 1, you can retain your same $10,000 ownership of this now larger pie by selling a portion of your ownership interest. And in this case, it would amount to almost 0.75%. And so the year 1 ending capital of $10,800, you sell off $800, and you end up with a 9.26% ownership interest in this now larger pie, which represents a $10,000 investment. And so someone has given you that $800 for that share, that fractional share, and of course you would pay a capital gains tax on that capital gain, which results in a diminished after-tax rate of return. And in this very simplified example, the after-tax return after year 1 might be the same, because the capital gains rate is equal to the ordinary income rate. In this case, the after-tax return would be the same. But there's value in thinking through a company's policy like this, where the source of your returns could be all capital gains, all dividends, or probably somewhere in between. But ultimately, and here are the key points to remember, the source of returns come from the company. Dividends are only a return of capital from the company. Dividends can incur additional tax, and it's always important to think about opportunity cost, both within the company, what kind of opportunities the company would have for reinvestment, especially if you're the manager at that company making the decisions, as well as your own personal capital opportunity costs. So I hope this is helpful in thinking through some of the mystique of investing in public companies, what the sources of returns are, where they come from. Please let me know if there's anything that was not clear, if there's any other questions you have. It would really mean a lot if you liked this video, subscribed to the channel, and even considered sharing this video. Thanks again for watching, and I hope to see you again very soon.